All right, stock started off ahead of a really important week with earnings from financial companies this week, as well as an inflation report due out tomorrow morning. Big inflation report that it seemed like the administration tried to get out ahead of today. The market didn't respond very well, especially the large cap tech names. So we're going to break that down, how the market reacted, what the indicators look like, how likely we actually got a pretty decent bullish signal by the end of the day today. We got a going forward into tomorrow. So we're going to break that down, then how likely it is to actually produce a bullish bounce. And we're also going to take a look at some major moves in different asset classes, especially bonds. What is that telling us? The difference between bonds and gold. We're going to look at that. And then we're also going to take a look at a stock that's kind of representative of the QQQs and the kind of pattern it's doing, how we should trade it. So let's go ahead and get started. Today is Monday, April the 11th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, you got light pink shading and yellow line. This is a bullish signal. This signal right here is an immediate bullish signal. So we either bounce up off of this, or just maybe go down a little bit tomorrow, or we are reversing, right? So like this is one of those signals that's what it says right there. It's a bullish signal that it's one of those really great reward to risk scenarios, because you'll know really quickly if it doesn't keep going up, right? We're down a 0.1% below the moving average, and it's like 2.5% is whenever for the S&P is whenever we feel like it's down in a significant amount to change the direction, right? That's what you saw over here. So that's where we're at there. So one of those, again, significant moves. Now we broke support, and that's an issue, right? Usually you like to have that 30-day moving average above the 38% retracement. Retracement of the 38% retracement of this intermediate run, right? So usually like to be above that, but we're below. We broke support. So you got another little layer here. You've got another layer at that 62% retracement as well. And of course, getting below 42.75-ish, where that long-term 23% retracement level is of this decline. I mean, that would put us back on a bearish move to the downside, right? So you can kind of see what it looks like here. So there's that long-term 23% retracement, and then this would be that 28, and then the 78% retracement of this current intermediate run. So in other words, we'd be back to bearish impulse moves here. We're in retracement mode. We're not in bullish impulse moves, but we're in retracement mode, and we'd be back to bearish impulse moves down here. So we're not there. We're 100 some odd points off of that. So hardly. I mean, the intermediate line's still in bullish territory. The near-term line's not really that significantly low. The momentum line is giving you this dip signal, this buy the dip signal. This ideally would be better if the intermediate line was above 80, but still, I mean, you have light pink shading, yellow line at an extreme low on the momentum line. That can be a short-term, very short-term buy signal on the market forecast. The NASDAQ 100 looks very similar, except the near-term line is also in extreme lows, and that's not the best. And we haven't dropped below the 62% retracement, which is where it's going to be some significant support, multiple Fibonacci lines lining up. But we did break this level pretty significantly. This is that long-term 23% that was lining up on that 38% of this decline. So and 38% of this intermediate run too. So he had three lines on different time frames lining up at the same level, and we were easily below that now. You could argue Friday we were just a little bit below. We're easily below, and we don't have light green shading and a yellow line. We have light pink shading, and a red line. And we're that close to dropping out of bullish territory. And like I said, an extreme momentum line, but we had that yesterday, and we did not bounce, or Friday. And then now today you got the near-term line. That's not good. That's not bullish. They have the near-term line that low. The Russell 2000 actually got us it's actually got a dark pink shading and a red line. And is almost back in bearish territory with some pretty oversold short-term sentiment. You notice it did drop below that 62% retracement, and now is flirting with, like, again, new bearish impulse moves to the downside. You're getting back below 78 and just pretty much ending this intermediate run that you're on right now. So that's why the Russell, and the Russell didn't drop as much today, but mainly because it had dropped the most out of the indexes going up to today. It was already below its 62% retracement on Friday, where some of them were just, the S&P is not below 38 and the Nasdaq was barely below. So it's a little bit less bearish, and that's why it was less it was more bearish previously, so that's why it was less bearish today. Let's take a look at how the long term, the weekly chart shaping up so far this week. And you'll notice again, you got that red arrow, you got the negative differential, and you got a falling PPO. That's the three, and a bearish candle here. That's the three things you look for on this particular chart. And they all three are in the bearish direction. Same thing with the Dow, but just not as significant. Okay, let's go back to this one. Same thing with the Dow. Same thing with the Nasdaq. Look at that bearish Hakinyasha candle this week so far. The red arrow came last week with the transition candle, and then of course the negative differential, and now a falling PPO. And then finally your Russell 2000. It got these signals last week too. The red arrow, the falling PPO, the negative differential, and this is following through with that this week. So you can see the weekly candles here are really reversing to the downside. You also see that showing up in the whole moving average as well. The whole moving average, you see, you are red. You got the bearish Hakinyasha candles. You've got the parabolic SARs well above you. I mean, this is bearish territory, and we are currently, the Hakinyasha closes back below the 200-day moving average, 200-day whole moving average. You look at SPX, same thing, very significant. I mean, look at that close. The Hakinyasha close got below multiple days worth of lows there, so that's why today's drop is a little bit more significant. That's why I'm a little hesitant to be too bullish on that really short-term signal from the market forecast, because that's a pretty bearish close there, a Hakinyasha close, mind you. And then looking at the Nasdaq, and that's a really bearish Hakinyasha close, closing below again multiple days worth of lows, similar to that close we had over there. And then of course we are well below, even more below the 200-day whole moving average, and everything is just red here. I had been mentioning to you previously last week about the stochastics breaking below. We talked about that last week. Well, you can see now, we are into the lower half of the chart, that we're in the lower half of the 4-week range. The 4-week average, we're below the 4-week average of this blue line, and it's risen up into the 80th percentile. And you can see the same thing for the Nasdaq. The Nasdaq is well below the midpoint of and about to get into bearish territory there. And then the Russell 2000 is well established in bearish territory, below the 40th percentile, and you can see that the 4-week average, we're well below the 4-week average, and it is now declining. So it's a smoother line, and it's starting to decline. So again, goes to show the direction of the mood right now. It doesn't seem like this is just a pullback to the downside. It seemed like we just had a pullback to the upside. Looking at some of these other oscillators, we are back above 25 in the negative index, almost above 30, back below 25 in the positive, but not below 20 yet. So not quite breakout to the downside. Closer on the Nasdaq, we are above 30 on the negative again, and easily above 25. Back below 25 and almost below 20 on the positive index, and then IWM. We were already above 25 and already below 20, and we're staying there. Not quite breaking above 30. That would help get the ADX rising again. So not quite there. We've been in such a noisy period for IWM, because we've been so sideways. You can see we've never been able to get above 50, and we're still not there yet. So still no real significant trending move yet. The bullish trend that we had on SPY is finally done. So we finally broke back into the cloud. And then the Qs, you can see, we are below the blue line. We are in the bottom of this wide cloud. Again, its bullish trend was kind of holding on for dear life, is now gone. Both these numbers are at 0. So you can kind of see that this has been a significant enough decline to suggest that we might have a really hard time coming up off of it. Looking at the RSI and the CCI, we're not in bearish territory, but we are in the lower half of the chart. Same thing with the Russell, though we did get below minus 200 on the Russell. And then today on the NASDAQ, we got well below minus 150 and floated in easily in the lower half of the chart. So we're working our way towards bearish territory, these oscillators, but at least we're in the lower halves, suggesting more downside. And then finally, looking at the Bollinger Bands, we are not quite in the lowest quartile on SPY. It's still a really wide bandwidth that's been falling sharply here. The bandwidth is falling sharply. The same with the Qs. We did get in the lowest quartile on the Qs, which is bearish. And then IWM, you can see, is also easily in the lowest quartile. When I combine that with the Keltner channel and this momentum down here, you can see the bands are still outside of the Keltner channel, which means we're still in trending mode. But in this case, we were trending to the upside. Now we're still in trending mode now to the downside. So with that red bar, it means some negative momentum in the lower quartile of that chart. The Qs are not quite. They're still in trending mode. The bands are still outside of the Keltner channels, but we still have this waning positive momentum. We don't have the negative momentum yet. And the same thing for SPY. Still don't have that negative momentum, even though the bands are still outside of these really wide Keltner channels. So we haven't shifted yet to bearish trending mode on a lot of these indicators. We're definitely not bullish anymore, that's for sure. Now, if I were to take a look at today's trading range, or just look at the 4-week range, SPY is flipping. I mean, look at this. This is the danger for SPY. Like, you get below 440 on the short term, it's really easy. Once we get in the lower half of the chart, there's no volume down there. So it's going to be a quick move if we get down into that area. IWM already is in the lowest half in the chart. We had kind of a breakaway gap to do that. And there isn't, again, we're below the value area. The top of the value area was today's high. We are below the value area, and there's no volume below us either. And then on the Qs, again, kind of we had this breakaway gap over here that we didn't fill, and we got another kind of a breakaway gap here today. And again, breaking below the value area, a lot of volume up here. Most of the 4-week range is in this really tight range. We broke out of that, and now, again, pushing lower high, lower low, closing at the low of the day, no volume below us. You can see how we're set up for not for a bounce to the upside, right? Like I said in the market forecast chart, I would suggest my expectation is we'll probably continue to move lower. And earnings are going to have a big factor in that, but we are, and also the options expiration on Friday will have a big factor on that too, or Thursday, because there is no trading day on Friday this week, so keep that in mind as well. But you can see how we're set up for, from a technical perspective, we are set up for a very negative reaction to this week's earnings. Now, if we can get a surprise and a positive surprise and bounce back up and fill in some of these gaps, great. But the technical environment is set up for a negative reaction. It's going to be easier to have a negative reaction than it is going to be to have a positive reaction. And even if we do bounce, you can see all the resistance up above. So we might not bounce very much. Keep that in mind, especially on the initial knee-jerk reactions to a lot of these reports that are going to be coming out. Let's take a look at today's trading range and volume. So we got the pink shading on the Russell. We've had pink shading now for 4 days. That's not a one and done day, but so far it is one and done on the Qs and the spiders. So if we can be one and done and bounce back up, great. Back to, there's a good probability we'd be bullish. If we follow the trend of the Russell, not so good, right? 4 days is probably too much, and we're most likely probably going to have 5 or 6 days. I highly doubt we're going to get too far up. We're pretty decently below the moving average. You can see the ranges have been relatively small the past couple days there on the Russell. Again, looking at the volume and trading range, 89 million shares, and the range today was 5.5 points. But you have to account for that gap there. So 447.5. The high was 445. Yeah, 447.5. So about 2.5 more points. So we are over 8 points. So we are above average on the range. Above average on the range, over 8 points right there. Well over 1%. And really probably over 1.5%. And then the volume, 89 million is above the average too. Again, we start getting bigger ranges and bigger volumes. Again, that's bearish, right? And And you saw volatility today ramped up to the upside. One of the bigger moves it's had. In fact, if you look at the VIX on this chart, in here, let me. So this has the potential of being pretty, the scale gets really thrown off here, right? Because of that big, the day after Thanksgiving, 54% rally in the VIX. But since then, let me cross over there. Okay, since then you can see, can't really see. There we go. Since then you can see 15% is a big number, and we've had some of these big runs, followed by some negative days. But you can see some of the bigger days in volatility when we ramp up to 18% or 19% or 18%. They tend to be followed up with other big volatility days too, especially when you look at the VIX being above, getting above its 17-day moving average today for the first time, closing above the last couple days highs. The MACD is still above its moving average and rising, strong momentum. We're still not above those moving averages here, so it seems like there's a rising momentum there for the volatility index. So again, a lot of signs that there's this little bounce, and you can see the 3 red arrow signals is actually a bullish signal, not a bearish signal. So we do have a very short-term bounce signal. The problem is not a lot of these other indicators are suggesting that a lot of these indicators suggest that we maybe have been too bearish to get to this point, that we have so much bearish momentum that it will probably keep going rather than bouncing, which is what it typically does in a good bullish trend, which obviously we're not in. So despite those nice bullish signals, my expectation is we'll probably continue to move to the downside tomorrow. And again, I'm not doom and glooming. I'm just expecting, similar days of what we've seen here recently. Nothing crazy, nothing too hardcore, but just the trend is to the downside, and I expect the markets continue to follow that trend going into through this earnings week and after expiration. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. Whether you might reply to the tweet or the Facebook post or here in the YouTube section, but comment on what you think I brought up here from a technical perspective, and let me know what charts you're looking at as well. Reply with those to the tweet or in the comment section with what charts you're looking at. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us you liked our video today and that you want us to do another video again tomorrow. It's a quick way to give us feedback if you like our stuff. If that's the case, click that thumbs up icon. If it's not the case, then you don't have to click on anything. Also, while you're down there, comment. What did you get out of the videos today? What stood out to you? What questions or comments you have about anything I said or brought up? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, check out some of these other things over here on the right. Click on this icon that takes you to our Market Outlook live page. On Monday, Wednesday, and Fridays at 3:30 Eastern Time, I do a quick little live video on this page. It's 10 to 15 minutes long. I take a look at all the trades that we've done in prior market outlooks to see whether we should stay in them or get out of them. So we continue. When I give you a trade idea, we don't just, I stay in. We actually trade it and I stay in it until we get out of it. And this is the video we talk about when should we get out of it. I also put on today's trade idea before the market closed today, so you can find out that there again at 3:30 Eastern Time. On this particular page. Come over here, click on that View More button. That takes you to our calendar. You can see our upcoming classes that we have. You can see we have a holiday on Friday here. We have 4 years worth of recordings going backwards there. Come down to the bottom, click that heart. It opens up this tab. Hit that like button. Same thing with that thumbs up icon. Click the like button there as well. Again, the more you do that, it helps us get more reach. It helps our content get out to more people. Because that's why we always ask you for the likes and the retweets and the comments on these. It also benefits you because Twitter and Facebook promote content and your timelines from the accounts that you engage with the most. So we try to make it easy for you to engage with us right here, right now, while you're watching. Now let's take a look at what's driving the price action today. And you can see clear risk on day today, where you have gold, or risk off day, excuse me, with gold and the dollar up. IWM held up for most of the day. It really kind of lost at the end of the day, but for most of the day it was really outperforming. It was the Qs that really broke down really hard. Ended up being down more than 2.33%. The S&P being dragged down below it with it, and interestingly enough, long-term bonds were also the biggest loser. So when you have gold and the dollar moving together, and they're the only ones that are rallying, that's about as risk off as you can be. Because, you know, again, the alternative would be bonds would be up there too. But even no one even really wanted to buy bonds. They did at the very end of the session, but still, you can kind of see how just how bearish people really are all across the board. There's your dollar index still rallying, trying to keep this momentum going that it's got. It's definitely not as strong momentum as what we saw on this leg lower, and it seems like we are kind of fleshing out a double bottom here. The histogram is rising, so we'll see how things turn out for the dollar from that perspective. Of course, gold is bouncing up off these moving averages, getting back above the 30-day moving average. MACD and stochastics are rising back to bullish territory again. Long-term bonds, as we mentioned, is really just going parabolic here. Again, it's at the lowest. The MACD is at the lowest level of the past year. You have to go all the way back 5 years, and we're in the lowest 5th percentile of closes over the past 5 years. If you go out 10 years, you can see we're in the lowest 10th percentile. So we've had other momentum down over here, and after the election in 2016, we had a precipitous decline when we were already below the 200-day moving average. Keep in mind, we happen to also be below the 200-week moving average here, and so here's your long-term MACD, and it's really now when we get this low in the past, we're in the 2nd percentile for the last 10 years on a weekly basis, and you go out to the 20-year chart, and again, you know, this we don't get this low very often, and these low points have formed, you know, got some pretty decent rallies, not necessarily a trend-changing rally in this case, nor in this case either. We just kind of got a bounce, but we did come off of these low. This one was a pretty significant trend-changing rally. Once we started to taper, and then QE ended there, and then of course you have the post 2009 rally in equities that produced a significant low point there, and we kind of touched that low point multiple times in 2009, again in 2010, and then early 2011, and then it took off. Bonds took off. So needless to say, you got some really sharp momentum here to the downside, trading around this 125 level. Really important support down here around the 78% retracement, as well as the point of control. This is the point of control for the last 20 years, right? But it's also the point of control, as you can see, just for the past 5 years. There's a big volume node down there. We broke below that. There's technically the point of control right there, and then again the last 10 years point of control right here. So there's some significant support in this area, and you can see the MACD is about as low, really, as it. I mean, it can go lower, of course, but you see how significantly lower it is. I mean, look how parabolic the daily chart has gone. I mean, it's pretty rare for the DMI to get this high on a negative basis. You can look back in the last 5 years; it's not very common for it. And you can see that to combine that also with the positive indicator getting below 15, it's also really rare. Only a couple of times, you know, one time here and then another time over here, and this time didn't include such a strong. So really, this is the only other time, right where my cursor is, that we had such a significant decline in bonds to such a degree, and that one you still had a little bit more room to go until you hit support, and we kind of diverged. We hit a divergent low point there. We're at support. In fact, we're kind of flirting a little bit with below support, but we're at support here with the market forecast chart showing us some oversold signals. The oversold cluster on the daily chart, which we just continue to get with the market sentiment line, no less. And then, of course, the weekly chart also getting us a cluster so far this week. The week's not over with, but so far this week you're getting a cluster with all three lines below the 10th percentile, and market sentiment being and again being significantly below the 200-week moving average. 30-week moving average being 13% below. That's the lowest in the last 5 years, and you have to go back. It's in the second percentile for as low in the past 20 years. So again, this is a significant low point. It really sets up for a significant move to the upside in bonds. The problem is significant moves to the upside in bonds typically aren't the most bullish. Lately they have been. In 2019, that was when the Qs were outperforming. And if bonds rally and the Qs can't rally, then that's going to put some pressure. And you don't expect the yields will continue to go down because we have a back over here, the Fed was not raising rates anymore. The Fed stopped raising rates right there in December, and then bonds took off. And remember, the Fed cut rates there. So the Fed is not necessarily cutting rates right now. They're going to be raising rates, and you can see while that's put some pressure on bonds, I think it's pulled forward a lot of that weakness into this move. We're not going to take off, but I do expect that we will move up towards resistance levels once we start to get a more of a broad risk averse like this little move really since the beginning of the year. If I go back to year-to-date moves here, and let's go year-to-date on this. Year-to-date, way down at the top. It's actually at the top. So here's our, bonds are down the biggest loser for the year so far, and then you can see gold and the dollar rallying, and then commodities holding up really well. If I go back 1 year, commodities are up 58% in the last year. Bonds are down, and gold and real estate are up. And the dollar's up, interestingly enough, but gold and real estate are up, and that's a very inflationary pattern, obviously. You can see the inflation levels here, and the Qs you see the margin of safety that they have. Everything else is down here from an equity standpoint, and the Qs have more room to fall because they've been holding up, and now you can see that disparity is changing. I showed you one chart a while back when we compared the Qs, if you recall, to IEF, right, the long-term bonds here, and we compared that to the Qs. And we talked about how they had moved from this low point here. They had gone in opposite directions, right? IEF kept coming down, and they had been positively correlated, but IEF kept coming down and the Qs kept rallying. Well, it looks like that correlation is back to being positive. We talked about something's got to give. One of these is going to be wrong. So something's got to give, and it looks like it was the bond market that was right and the Qs that were wrong. And again, if you look at where IEF is relative to that low point up here, we're way lower, and the Qs are still pretty higher, significantly higher. So it kind of goes to show, how much further the Qs can go. The Qs can easily fall down to this 38% retracement, 315. Relative to where long-term bonds right now says that they should be, that the Q should be. Let's take a look at the sector rotation. So give me 1 second to do that. Here, and let's take a look at just today alone again. Energy had been such a big winner with commodities. They were down, technologies down, communication services down, healthcare coming down today. On the other end of the spectrum, your best performers, interestingly enough, are your cyclical areas. Industrials, financials, materials all held up well today. That's not very common. Look at utilities really getting hit hard, and staples down, though outperforming. So not your typical risk off day. Usually you'd see staples and utilities and real estate up here. Utilities, they've been so strong year to date that it's not too surprising that they're giving up some of their gains. You can see they've been the biggest winners, healthcare, energy especially, and then there's your three big losers down there to the downside. If you go back again just to the 1 year chart here, you can see energy is up 60% coming off of very significant low points. And then there's your XLK, XLY, XLC starting to catch down to where, like I said, long-term bonds says that they probably should be right now. And you got all your safe haven sectors, real estate, healthcare, utilities, and staples, all the outperforming asset classes outside of the energy sector there. If I were to come over here and take a look at this chart, let's go back to the sector ETFs and the weekly charts again. Your sectors with the most momentum, and here let's just go to a daily version on this. The sectors with the most momentum right now on the daily chart are staples, real estate, and utilities. I mean, that's risk off. That's safety trade. On the other end of the spectrum, with the least momentum is industrials, financials, and energy. And there's your cyclical trade. Now they're rising, but they're still the lowest momentum, and they're the lowest relative strength. And your best relative strength right now is real estate, utilities, and materials are holding up in terms of a relative strength. So you can see the risk-off nature. You can also see it too in some of these charts. If I take a look at the new highs and new lows index dropping below 500 again, that's a significant low point, back below the average. It's a really significant low point here. It just goes to show just how bearish we are. We were positive briefly, and we talked about that, and it was really good. And it was like, oh, if we can get above 100, see all these other instances couldn't get above 100, and all these other declines, we really didn't get down very low, but we are definitely below this minus 300 or whatever you want to use for a significant low point that really starts the declines. You can see it's kind of more like right around 250. Getting below 250 and breaking below that, you can see we get down to around 250 and bounce on all these other intermediate pullbacks and such. Obviously, getting to negative 600 is a really important level, and you can see the skew also dropping back down below its moving average. It's bearish for the skew to be below its moving average. It's 20-day. The MACD is dropping below zero, so that would suggest that the skew is going to be dropping for a while, and of course that's typically associated with risk aversion and not necessarily risk off modes. I've shown some charts. The Qs are breaking down here relative to IWM. If you take a look at like utilities relative to financials, and a little bit of a down day today, a pullback day, but you see how bullish the trend is, and you can see how it's kind of just getting started in terms of this rotation into the safety aspect, right? You can see that you're getting up to the 200-week moving average. These weekly moving averages are just crossing over each other. It's made a really good run to get to this point. We might settle down some of this move, but look at that negative PPO just starting to move higher. You can do the same thing with staples relative to discretionary stocks, and you can see the PPO still very negative and still rising. So there's a lot of opportunity. As bullish as we've been, there's a lot of opportunity for us to continue to be bullish in a lot of these safety areas for equities. All right, so for our trade idea of the day, I wanted to take a look at Amazon. You can see Amazon is showing its own bearish patterns. It's almost 3% below its moving average. It's obviously light pink shading and yellow on yesterday, Friday. Now it's got the dark pink or dark red line. Both the momentum and near-term lines, like the Nasdaq, are in this extreme oversold levels, with the intermediate line really dropping pretty sharply. If you notice that we got the divergence going on, you're easily below the 17-day moving average, and you are dropping now below the 50% retracement. You're dropping below the point of the value area. The last year is a very small value area. There's not as fat. You can see as fast as we're moving through this volume the last couple of days, there's even less volume below us now, and the MACD has just gone negative, below zero. It's obviously been below its moving average now, so we've been in this bearish divergence. You can see the stochastics is dropping really sharply. A lot of other indicators looking pretty bearish. The DMI is above 30, almost below 20 on the positive. Pretty significant. I mean, almost as negative on the. There's almost as negative already on the high, on the negative indicator as we were on the positive during this latest rally. If you look at the RSI and the CCI, getting down to lower halves of the chart, almost into bearish territory for the RSI, and easily getting to bearish levels on the CCI. Looking at the trend, we had a pretty decent bullish trend going, obviously no longer, and we are into the cloud now. Shows again just how we've just lost whatever strength that we had. And then from a Bollinger Bandwidth standpoint, like the NASDAQ, you're dropping pretty sharply, again, below the 38% retracement, which happens to be the bottom of the value area, so big break below support. And then we are in the lowest quartile, getting down to the 17th percentile of the bandwidth. So significant drop in that perspective. And you can see the weekly chart is really looking bearish. The Heikin-Yashi candle is that's a pretty significantly bearish candle, pretty good size, and the PPO falling back down. It looks like Amazon's headed for a leg lower. So what we did on today's trade idea is we went to the May contract here. I'll show you here in just a second. Here we go. We went to the May contract, and we bought the at-the-money put and sold one strike away. So we ended up buying 30.15, selling the 310, going for about a half a normal position size because you do have earnings that will be coming out. So we went for normal position size because of that earnings, but getting a pretty decent, bigger than a normal reward, even though we're half the normal risk. Relatively high probability. We don't have to worry about anything too major. You can see about a 52% probability, and pretty much 52% probability of making anything. There's a very small probability that we will either be not a maximum gain or not a maximum loss on this. So again, 51.84% probability of making $520. Again, to kind of give you an idea what that means. We're making on average about $270 on this trade. If we did 100 of these trades, we'd make it 270 on average across all the winners and the losers at that probability. So pretty decent trade. Again, keep in mind that your normal probability of making $300 is about 60% for high probability trades. So you can see how this is a higher value trade than your normal short vertical spread would be, despite the probability not being as high, right? Not being above 60% there. And if it doesn't work out, instead of losing $1,000 like I do on those trades, I'm only losing $480 in the worst case scenario to the downside. You can kind of see here on a regular, if I was risking $1,000 and a 30% chance roughly of losing, which is typical, that's my average loser. Here, my average loss is $231. So even this is a smaller loss than what we would get typically on my, on a typical short vertical spread. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there. If there are any questions or comments you have, reply to anybody else's thread. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video down below. You can also subscribe to our website for free at marketscholars.com. Like us on Twitter and Facebook as well. Remember, you can reply on our Twitter to those Twitter posts too with any charts you're looking at. Have a great rest of your Monday night, everybody, and we'll see you all next time.